Every major financial crash follows the same script. Markets plunge, millions lose their savings, retirement accounts evaporate. Then the recovery begins, slowly, painfully. And when the dust finally settles, something has shifted. The middle class is weaker. The working class is poorer. But the wealthiest institutions, the ones closest to the money system itself, they own more than before. Much more. This isn't random. This isn't bad luck. It's a mechanism, a structural feature of how modern markets operate. And once you see it, once you understand the specific steps that repeat in every crash, you'll realize something unsettling. Financial crises don't destroy wealth, they relocate it. Let me show you the pattern. Let me show you how crashes function as extraction events, how the system is designed so that volatility flows downward while assets flow upward, and why every major crisis in the last century has left ordinary people weaker while the institutions at the top emerge stronger, richer, and more concentrated. This is the wealth drain mechanism. In 1929, the stock market collapsed. 13 billion in market value disappeared in days. That's over 200 billion in today's money. Banks failed. Unemployment hit 25%. It was the worst economic disaster in American history. But by 1936, the wealthiest families in America, the Mellons, the Rockefellers, the DuPonts, they owned a larger share of national wealth than they had in 1929. The crash destroyed the middle class. It consolidated the elite. The same pattern played out in 1987 when markets crashed 22% in a single day. Ordinary investors panicked and sold. Institutional investors bought. By 1990, wealth concentration had increased. In 2008, 15 trillion in household wealth vanished. Foreclosures destroyed millions of families. But the largest banks, the ones that caused the crisis, received bailouts. They bought distressed assets at rock-bottom prices. By 2013, they controlled more of the economy than before. And in 2020, during the pandemic crash, 40 million Americans filed for unemployment. Small businesses collapsed, but the billionaire class gained over $1 trillion in net worth in just 8 months. The fastest wealth transfer in recorded history. This is the pattern. Crisis, panic, selling, consolidation, recovery. And every time it repeats, the people at the bottom lose permanently, while the people at the top gain structurally. This isn't accident, it's engineering. To understand how the mechanism works, you have to understand the architecture of modern finance. Start with this fact. Most people own assets indirectly. Your retirement account owns mutual funds. Those funds own stocks and bonds. You don't control when to buy or sell. The fund does. But institutions, pension funds, sovereign wealth funds, central banks, they own assets directly. They control timing. They have cash reserves. And most critically, they have access to credit that ordinary people don't. When markets are stable, this distinction doesn't matter much. Everyone's portfolio grows. But when volatility hits, when markets crash, the difference becomes everything. Because the mechanism that drains wealth operates through forced liquidation. Here's how it starts. Markets begin falling. It doesn't matter why. A pandemic, a banking crisis, a bubble popping, the trigger is irrelevant. What matters is the cascade that follows. As prices drop, margin calls hit. If you borrowed money to invest and your investments lose value, your broker demands you deposit more cash or they'll sell your holdings. Most retail investors don't have spare cash sitting around, so they're forced to sell into a falling market. This accelerates the crash. More selling, lower prices, more margin calls. It's a spiral. Institutions face margin calls too, but they have liquidity buffers, credit lines, cash reserves. They can meet the calls without selling, or they can choose when to sell strategically. Retail investors can't. They're forced to liquidate exactly when prices are worst. Now add the second mechanism. Forced selling from passive funds. Most people invest in index funds. Those funds are required to track their index. If the index includes a stock, the fund must own it proportionally. But when redemptions spike, when investors panic and withdraw money, the fund has to sell holdings to pay them. It doesn't matter if prices are terrible. The fund structure requires liquidation. This creates a predictable pattern. Retail panic, redemption surge, funds sell, prices drop further. Institutions know this. They can see redemption data. They can see forced selling coming. So they wait. They hold cash or shift to safer assets before the worst hits. Then when forced liquidation drives prices to extremes, they buy. Not because they're smarter, because the structure gives them information and timing advantages that retail investors don't have. This is the first phase of the drain. Forced liquidation transfers assets from weak hands to strong hands, from people who must sell to people who can choose to buy. But the mechanism doesn't stop there. The real extraction happens in the second phase, the bailout. In every major crash, governments intervene. They call it stabilizing the system, preventing collapse, protecting jobs. And there's truth to that. If major banks fail, if credit freezes entirely, the economy seizes. Depression follows. So governments act. They lower interest rates. They inject liquidity. They buy assets. They guarantee debts. But here's what this actually does. It transfers risk from private institutions to the public. Look at 2008. The largest banks made catastrophic bets on subprime mortgages. Those bets failed. The banks faced insolvency. In a normal market, they would have failed. Shareholders wiped out, bondholders taking losses, assets sold to more prudent institutions, the market clearing. Instead, the Federal Reserve and Treasury stepped in. They declared the banks too big to fail, $700 billion in direct bailouts through TARP, another $4 trillion in Federal Reserve lending programs, unlimited liquidity, zero interest rates. The banks didn't just survive, they thrived. They used the bailout money and cheap Fed loans to buy distressed assets, mortgage-backed securities trading at 20 cents on the dollar, commercial real estate in foreclosure, residential homes sold by families who couldn't make payments, the biggest transfer of property in American history. And it flowed in one direction, from households to banks. Here's the specific mechanism. Families lose jobs, can't pay mortgages, face foreclosure. Banks take the property. But banks also received bailout money specifically to stabilize their balance sheets. So they're buying distressed property with public money while foreclosing on private homeowners. It's a double extraction. The homeowner loses the house, the bank acquires the asset. By 2015, Wall Street firms owned over 200,000 single-family homes, properties bought during the crash at depressed prices, now rented back to the same communities that lost them. This is the bailout mechanism. Privatize gains during booms, socialize losses during crashes, use public money to stabilize institutions, then use those stabilized institutions to buy assets at crisis prices. It's extraction by policy design. And it repeats every cycle. The third mechanism is monetary expansion. When central banks respond to crashes, they expand the money supply. Quantitative easing, asset purchases, liquidity injections. The language is technical, but the effect is simple. They create new money and use it to buy financial assets, bonds, mortgage securities, sometimes stocks. This drives asset prices up. If you own assets, your wealth increases. If you don't own assets, you're excluded from the recovery. And who owns assets? Disproportionately, the wealthy. The top 10% of Americans own 89% of all stocks. The top 1% own over half. So when the Federal Reserve injects trillions into financial markets, 89% of the benefit flows to the top 10%. Over half flows to the top 1%. Everyone else gets wage stagnation and inflation. This is why every recovery since 1980 has been characterized by surging asset prices and flat real wages. The recovery isn't broad-based, it's concentrated. Monetary expansion inflates the value of assets held by the wealthy while doing almost nothing for people who live paycheck to paycheck. And central banks know this. There are internal Federal Reserve studies documenting that quantitative easing increases wealth inequality, but they do it anyway, because the alternative, letting asset prices collapse, would mean losses for the institutions that own those assets. The banks, the funds, the bondholders. So the central bank chooses to stabilize asset prices even though it widens inequality. This is the third phase. Monetary policy as wealth transfer. Print money, buy assets, inflate prices, reward ownership. If you were already wealthy, you get wealthier. If you weren't, you fall further behind. Now layer these three mechanisms together. Forced liquidation during the crash. Bailouts that transfer risk to taxpayers while subsidizing asset purchases by institutions, and monetary expansion that inflates asset prices, disproportionately benefiting the wealthy. The result is a ratchet. Wealth concentrates upward with every cycle, and it's accelerating. Look at the data. In 1989, the top 1% of Americans held about 23% of total wealth. By 2007, before the financial crisis, it was 33%. After the crisis, after the bailouts and quantitative easing, it hit 37% by 2013. During the pandemic, after the 2020 crash and the largest monetary expansion in history, it reached 43%. Every crash tightens the ratchet. Every intervention concentrates wealth further. And the mechanism is structural, not incidental. It's built into the design of the system, because the system prioritizes stability for institutions over fairness for individuals. When markets crash, the response is always the same. Protect the banks, protect the bondholders, protect asset prices, even if it means transferring losses to the public, even if it means increasing inequality. The rationale is systemic stability. There is a logic to preventing total collapse, but the choice isn't binary. Governments could stabilize the system while imposing losses on shareholders and bondholders. They could bail out depositors without bailing out banks. They could buy distressed mortgages and restructure them for homeowners instead of foreclosing. They don't, because the people who design policy, the people who run central banks and treasuries, they come from the institutions that benefit. It's not a conspiracy, it's alignment of incentives. A former Goldman Sachs executive becomes Treasury Secretary. A former central banker joins a private equity firm. They genuinely believe stabilizing markets means protecting institutions, and their career incentives reward that belief. So policy consistently favors creditors over debtors, institutions over individuals, asset prices over wages, and the mechanism perpetuates. Let me show you how this played out in a different country, a different crisis. Japan in 1989. The Japanese stock market was the largest in the world. Real estate prices in Tokyo were higher than anywhere on earth. It was a bubble, and everyone knew it, but no one thought it would collapse. It did. Between 1989 and 1992, Japanese stocks lost 60% of their value. Real estate prices fell 80% in some areas. Household wealth evaporated, but the largest Japanese banks, the ones most exposed to bad real estate loans, they didn't fail. The Bank of Japan intervened. Zero interest rates, unlimited liquidity. Banks were allowed to hide bad loans on their balance sheets for decades. No forced recognition, no liquidation. The banks survived, but they also stopped lending. They became zombie institutions, technically solvent, but functionally inactive. And the Japanese economy stagnated for 30 years. But here's what happened to wealth distribution. Before the crash, Japan had relatively low inequality. After the crash, during the so-called lost decades, inequality widened steadily. The wealthiest families and corporations, the ones with access to cheap credit from the Bank of Japan, bought assets at depressed prices. Real estate, stocks, corporate bonds. By 2020, Japan's top 10% owned over 60% of financial assets. The crash and the policy response concentrated wealth even in a stagnant economy. The mechanism worked. Crisis, intervention, asset consolidation, inequality increase. Same pattern, different country. Now look at Europe after 2008. The sovereign debt crisis. Greece, Spain, Italy, Portugal. Governments faced insolvency. Bond markets panicked. Interest rates spiked. The European Central Bank intervened. Mario Draghi, the ECB president, announced the bank would do whatever it takes to preserve the euro. That meant unlimited bond buying, quantitative easing, negative interest rates. It worked. Markets stabilized, but the cost was imposed on ordinary citizens. Greece was required to implement austerity, pension cuts, wage cuts. Unemployment hit 27%. Public assets were sold. Ports, airports, utilities. Privatized and sold to foreign investors at distressed prices. The Greek people lost wealth, lost income, lost public property. But Greek government bonds, the ones held by German banks, French banks, ECB itself, those were protected. No defaults, no haircuts for senior creditors. The losses fell on Greek workers. The gains, the recovery in bond prices. This is the mechanism operating at the sovereign level. Crisis, intervention, austerity for the public, bailout for the creditors. And it's the same structure. Risk socialized, gains privatized, wealth drained from the periphery to the center. Now bring it to the present. The 2020 crash was the fastest in history. The S&P 500 fell 34% in just over a month. 40 million unemployment claims. Small businesses closed permanently. But the response was also the fastest and largest. The Federal Reserve cut rates to zero within days. It launched $4 trillion in quantitative easing in a matter of weeks. It started buying corporate bonds, even junk bonds, for the first time in history. Direct support for corporate debt markets. Congress passed stimulus bills totaling over $5 trillion. Checks to households, loans to businesses, expanded unemployment, and markets reversed. Within 5 months, the S&P 500 was back to record highs. The recovery was faster than the crash, but look at who recovered. The stock market recovered, asset prices recovered, corporate profits recovered, billionaire wealth surged, but 20 million Americans were still unemployed a year later. Hundreds of thousands of small businesses never reopened. Evictions were only paused, not forgiven. Debt levels exploded, and inflation began rising, eroding purchasing power for everyone without assets. This is the mechanism in its purest form. Trillions injected into financial markets. Asset prices boom. The wealthy gain. Meanwhile, inflation taxes the poor. Jobs recover slowly. Wage growth lags. The people who lost jobs during the crash don't own stocks. They don't benefit from the asset price surge. They're excluded. And within 2 years, wealth inequality reached its highest level on record. But here's where it gets more specific. During the 2020 crash, who was actually buying? Look at the data. Retail investors, individuals trading on their own, they were net sellers in March 2020. Panic selling, liquidating retirement accounts, getting out before it got worse. Institutional investors were mixed. Some sold, some bought. But one group was buying aggressively. The Federal Reserve. In just 3 months, the Fed bought over $1 trillion in treasury bonds and mortgage-backed securities. That's direct demand in a crashing market. It put a floor under prices. And once that floor was clear, once it was obvious the Fed would buy unlimited quantities, institutional investors started buying too. Not because the economy was improving, because the Fed had signaled it would support prices. This is the Greenspan put, the Bernanke put, the Powell put, the implicit guarantee that the central bank will intervene to prevent sustained asset price declines. It creates a one-way bet for large investors. If markets rise, you profit. If markets fall, the Fed steps in and you buy at temporarily depressed prices, knowing support is coming. Retail investors don't have advantage. They panic because they're not sure there's a floor. They don't have inside information. They don't have relationships with the Fed. So they sell. Institutions know the Fed will act. They've seen it happen in every crisis since 1987. So they buy. This informational and structural asymmetry is the core of the drain mechanism. Now let me show you the fourth mechanism, the one almost no one talks about. Debt restructuring. During and after crashes, household debt often goes bad. Credit card debt goes unpaid. Auto loans fail. Personal bankruptcies spike. Banks take losses on this debt, but they also get to restructure it. Foreclosures transfer property from borrower to lender. Repossessions transfer cars. Bankruptcies discharge unsecured debt, but they also destroy credit ratings, locking people out of future borrowing. So the crisis clears bad debt off bank balance sheets, while simultaneously removing competition for future credit. People who default are locked out of the system. They can't borrow again for years. This reduces demand for credit, which means banks can be more selective, charge higher rates, and lend to more creditworthy, wealthier borrowers. It's a filtering mechanism. Crises purge risky borrowers and concentrate lending toward the affluent. And there's another layer. Debt buyers. Companies that purchase defaulted debt for pennies on the dollar, then pursue collection. During crashes, distressed debt is sold in bulk. A portfolio of defaulted credit card debt, face value 100 million, sold for 2 million. The debt buyer pursues collection aggressively. Even if they only collect 10%, they more than double their money. The original borrowers, already devastated by the crash, face relentless collection efforts. Wage garnishments, legal judgments. It extends their suffering for years. Meanwhile, the investors who bought the debt extract value from people with nothing left to give. This is another drain. Not just the initial loss, but ongoing extraction from the wreckage. Now consider what this means over multiple cycles. If you're wealthy, if you own assets and have access to credit, crashes are opportunities. You buy low, you hold through the recovery, you sell high, or just collect income from appreciated assets. Each cycle increases your wealth. If you're middle class, with some savings but mostly illiquid assets like home equity, crashes are setbacks. You lose home value. You might lose the home. Your retirement account drops and takes years to recover. You rebuild, but you don't get ahead. If you're working class, living paycheck to paycheck with debt and no assets, crashes are catastrophic. You lose your job, you default on debts, your credit is destroyed, you lose housing, and the recovery, when it comes, passes you by because you have nothing to recover, no assets to appreciate. So over 3 or 4 cycles, over 30 or 40 years, the wealth gap doesn't just widen, it becomes a chasm. The wealthy compound gains. The middle class stagnates. The working class falls into permanent precarity. And the mechanism ensuring this outcome is embedded in the structure of markets, bailouts, and monetary policy. Let me give you a concrete example. A tale of 2 investors in 2008. Investor A is a retail worker. She has $50,000 in a 401k, invested in index funds. When the market crashes, her account drops to $30,000. She panics and sells, trying to preserve what's left. She takes a $20,000 loss. It takes her years to rebuild savings. By 2015, she's back to $50,000. She's recovered, but she hasn't gained. Investor B is a fund manager. He has $5 million in assets. When the market crashes, his portfolio drops to $3 million, but he has cash reserves and access to credit. He doesn't sell. In fact, he borrows another $1 million at low interest rates, made possible by the Fed's intervention, and buys distressed assets. By 2015, his portfolio is worth $9 million. He more than doubled his wealth. Same crash, same policy response, opposite outcomes. And the difference is structural position. Investor A had no cushion, no credit access, no ability to wait or buy more. Investor B had all 3. The system didn't treat them the same. It drained from one and channeled to the other. And this happened millions of times simultaneously. Aggregate those millions of transactions, and you get the statistical result. Trillions transferred from the bottom 50% to the top 10%. It's not invisible. It's in the data. But it's not reported as theft. It's reported as market dynamics, rational responses to volatility, the natural outcome of risk and reward. But it's not natural. It's structured. Now look at how this operates in corporate consolidation. During crashes, small and medium businesses fail at much higher rates than large corporations. They have less access to credit, smaller cash reserves, no lines of credit with major banks. When revenue drops, they can't cover fixed costs, they close. Large corporations also suffer, but they have credit lines, they have relationships with banks that just received bailout money, they can borrow to survive, and crucially, they can acquire. When a small competitor fails, a large corporation buys the assets, the customer list, the equipment, the real estate, often at liquidation prices. This is how crashes drive consolidation. Each crisis kills small players and strengthens large ones. Look at retail. The 2008 crisis killed thousands of independent shops. Big box stores expanded. The 2020 pandemic accelerated this. Local retailers closed. Amazon grew 38% in a single year. Same pattern in restaurants. Independent places closed permanently. Chains survived with access to capital and credit. In every sector, the result is the same. Crisis, small business death, corporate consolidation. And consolidation means market power, means pricing power, means the ability to suppress wages and raise prices. It means wealth flows to shareholders of the surviving giants. Again, the drain mechanism. Volatility kills the weak, strengthens the strong, and the strong are those already wealthy, already connected to capital markets. Let me show you how this connects to housing specifically, because this is where the mechanism is most visible. In 2008, foreclosures hit record levels. Over 3 million foreclosures in 2009 alone. Families lost homes, but who bought them? Initially, it was supposed to be other families. The idea was homes would become affordable. New buyers would enter. But that's not what happened. Institutional investors, private equity firms, and Wall Street banks bought in bulk. Blackstone Group launched an entire division to buy foreclosed homes. Invitation Homes, Colony Capital, American Homes for Rent. These firms bought tens of thousands of properties, not to live in, to rent. By 2012, institutional investors owned over 200,000 single-family homes. They converted owner-occupied housing into rental properties. Families who lost homes in foreclosure now rented from Wall Street, and rent extraction is pure cash flow to investors. It's a permanent transfer. Ownership was consolidated. A generation of potential homeowners was converted into renters. And housing, which used to be a mechanism for middle-class wealth accumulation, became a mechanism for wealth extraction. This is the drain in physical form. Property flows from individuals to institutions. Rent flows from tenants to investors. Wealth concentrates. And it's accelerating. During the pandemic, institutional investors went further, not just buying foreclosures, buying entire neighborhoods, offering above asking price, outbidding families because they have access to cheap credit. They can borrow at rates individuals can't access, and they're competing with families using savings. It's not a fair market. It's a market where one side has structural advantages, and housing prices have surged as a result, making it even harder for new buyers to enter, which means more people rent, which means more extraction. The mechanism feeds itself. Now zoom out. Over the last 40 years, every major crash has followed this pattern. Forced liquidation, bailouts that protect institutions, monetary expansion that inflates asset prices, debt restructuring that punishes borrowers, corporate consolidation, housing conversion from ownership to rental. Each mechanism transfers wealth upward, and each crash accelerates the transfer. The result is the world we live in now, a world where 3 asset management firms, BlackRock, Vanguard, and State Street, control over 20 trillion in assets, more than the GDP of every country except the United States and China. A world where the richest 1% own more wealth than the bottom 90% combined. A world where each crisis makes this worse. But here's the critical point. This isn't the result of individual corruption. It's not a conspiracy. It's not a secret cabal meeting in shadows. It's a system operating exactly as it's designed. The people running it believe they're doing the right thing. They believe stabilizing markets protects everyone. And in the very short term, it does prevent total collapse. But the long-term effect, the structural outcome, is wealth concentration. And they know this. There are academic papers, central bank research. It's documented. But the system continues because the alternative, allowing institutions to fail, allowing asset prices to collapse, would mean short-term catastrophe. It would mean depression. And no policymaker wants to be responsible for that. So they choose the option that prevents immediate collapse, even though it guarantees long-term inequality. This is the trap. Not for them. For us. They're responding rationally within the incentives they face. But the system itself is designed to drain wealth from the majority and concentrate it at the top, and it uses crashes as the primary mechanism. Because crashes create forced liquidation, create panic, create the conditions where assets transfer from weak hands to strong hands, from people who must sell to people who can wait and buy. And here's what you need to understand about the next crash, because there will be one. The mechanism is still in place, the structure hasn't changed, central banks still prioritize asset prices, governments still bail out institutions, monetary policy still disproportionately benefits the wealthy. So when the next crisis hits, when markets crash, again, the same pattern will repeat. Retail investors will panic and sell. Institutions will buy. Central banks will intervene. Asset prices will recover. And wealth will concentrate further. The ratchet will tighten again. And each time it happens, the starting point is more unequal. So the effect is more extreme. This is why wealth concentration is accelerating. It's not just that the rich are getting richer. It's that the system is designed to transfer wealth upward during crises. And crises are inevitable. They're built into market cycles, booms and busts. Volatility is inherent. So the drain mechanism is perpetual. It operates every cycle. And every cycle makes the next one worse because inequality itself creates instability. When wealth is concentrated, consumption is weaker. Debt levels rise. Bubbles form more easily, which means crashes become more frequent, which means more opportunities for extraction. It's a feedback loop. Concentration creates instability. Instability creates crashes. Crashes create concentration. And here's the final piece. The people who benefit from this mechanism, they're not ignorant of it. They understand how it works. They position themselves accordingly. They hold cash before crashes. They have credit lines ready. They know central banks will intervene. They buy distressed assets with confidence because they know prices will recover. It's not insider trading in the legal sense, but it's insider knowledge, structural knowledge, understanding how the system operates and using that understanding to profit. And that knowledge is not equally distributed. Retail investors don't have it. Working class families don't have it. Even most small investors don't have it. It's concentrated among people who work in finance, who design policy, who sit on central bank boards. The information asymmetry is part of the mechanism. So the drain isn't just about money. It's about knowledge, about access, about structural position within the system. And that position is inherited and reinforced. If you're born wealthy, you have access to this knowledge. You're trained in it. You have family connections to people who operate the system. If you're born middle class or poor, you don't. You learn to save, to invest in index funds, to trust the system. And when crashes come, you lose. Not because you're foolish, because the structure works against you. So what does this mean for you right now? It means understanding that market volatility isn't random noise. It's the mechanism operating. It means recognizing that crashes transfer wealth. They don't destroy it. It means knowing that the policy response to the next crisis, the bailouts, the monetary expansion, they're predictable. They'll follow the same pattern. And it means understanding that the system isn't designed to serve you. It's designed to serve the institutions that control capital. This doesn't mean you can't navigate it, but it means recognizing what you're navigating. It means understanding that the deck is structured, that the game isn't neutral, that every crash is an extraction event. And if you're holding assets, when it happens, if you can avoid forced liquidation, if you can hold through the panic, you can survive it. But if you're living paycheck to paycheck, if you're in debt, if you have no reserves, the crash will hit you harder, and the recovery will leave you behind. That's not moral judgment, it's structural reality. The wealth drain mechanism is functioning right now, every day, not just during crashes, but crashes accelerate it. They're the moments when years of gradual extraction happen in months, and the next crash is coming. It always does, and when it arrives, you'll see the same pattern, the same forced selling, the same bailouts, the same concentration. And if you understand the mechanism, if you can see it operating in real time, you won't be confused about why you're struggling while the markets are recovering. It's for the people who own the assets, the people who control the credit, the people who built the system. They're not villains. They're not evil. They're operating rationally within a structure that rewards extraction. And that structure has been refined over a century, tested in every crash, improved with every intervention. It's not going to change. Not without a crisis so severe that the entire system breaks. And when that happens, if it happens, the people at the top will rebuild it. And they'll build it the same way. Because it works. For them. This is the machine. This is how it drains wealth upward. And this is why every crash leaves you weaker and them stronger. If you understand that, if you see the pattern clearly, then you're awake to how the system actually operates. Subscribe if you want to keep seeing these patterns. If you want to understand the mechanisms that textbooks won't explain and that policymakers won't admit. Because the wealth drain isn't stopping, it's accelerating, and the only defense is seeing it clearly.